The market opens. Screens flicker. Charts move. Billions of dollars shift in silence. But this time, something is different. No panic trades. No euphoric buying. No fear-driven selling. Before a single dollar moves, a system pauses. It asks one question. What are humans feeling right now? Then it adjusts the future. Every financial crisis shares a secret. Not greed, not policy, not technology. Emotion. Fear crashes markets. Hope inflates bubbles. Panic destroys wealth faster than war. For centuries, finance pretended to be rational. It never was. But what if that finally changed? What if emotional intelligence, true, measured, scientific emotional intelligence became the foundation of financial planning and investment decisions? In this world, emotional intelligence isn't a soft skill. It's infrastructure. AI systems continuously analyze human emotional states at scale. Stress, fear, confidence, overconfidence, collective anxiety, irrational optimism. This data feeds directly into investment portfolios, retirement planning, risk assessment, market timing. Lending decisions. Finance no longer reacts after emotions erupt. It anticipates them. No one reads individual thoughts. No one manipulates feelings. The system measures emotional trends the same way meteorology measures weather, not to control storms, but to prepare for them. Tulip mania, the Great Depression, the dot-com bubble, the 2008 financial crisis. Crypto booms and collapses. Different eras, same pattern. Rational models ignored human psychology. In reality, punished them. Traditional finance models risk mathematically. This system models risk emotionally. It understands one truth. Humans don't fail markets. Markets fail to understand humans. The system gathers signals from multiple layers. Behavioral finance data, social sentiment trends, stress indicators from economic activity, consumer confidence patterns, decision volatility metrics. AI translates emotion into probabilities. Fear spikes. Risk tolerance drops. Euphoria rises. Bubble risk increases. Fatigue spreads. Productivity forecasts adjust. Portfolios rebalance automatically. Old finance reacts after crashes. Emotion-aware finance responds before panic peaks. Old systems blame individuals. This system adapts to human nature. Your financial advisor is no longer guessing your risk tolerance. It knows it. Not from a questionnaire, from patterns. When stress rises, exposure reduces. When clarity returns, growth resumes. Retirement plans adapt to emotional resilience, not just age. People stop sabotaging their own futures. Not because they became wiser, but because systems stopped demanding impossible rationality. Emotionally overheated markets cool automatically. Overconfidence triggers safeguards. Fear triggers stabilization, not collapse. Booms soften. Crashes slow. Volatility declines. Pilots don't manually correct every turbulence. Autopilot stabilizes. Emotion-aware finance does the same for markets. Short-term hype relies on emotional extremes. Those extremes are now detected early. Speculative bubbles struggle to inflate. The system doesn't ban risk. It prevents irrational escalation. Companies are evaluated not just on profits, but on emotional sustainability. Workforce burnout increases risk scores. Leadership instability raises borrowing costs. Toxic cultures become financial liabilities. Healthy organizations become safer investments. Once, workplace safety was optional. Then it became essential. Emotional sustainability follows the same path. Recessions don't vanish, but their shape changes. As fear rises, systems inject liquidity earlier. Confidence stabilizes faster. Recovery begins before collapse accelerates. Interest rates no longer respond only to inflation. They respond to collective emotional overheating. Panic is treated like inflation. Unchecked emotion becomes a systemic risk. Impulsive decision-making disproportionately harms the vulnerable. Emotion-aware systems level the field. Poor financial choices are cushioned, not erased, but softened. Some people stop learning financial discipline. They rely entirely on emotional automation. A new risk emerges. Psychological complacency. Who defines healthy emotion? Is suppressing fear, manipulation, or protection? Governments debate boundaries. Transparency becomes mandatory. Strict safeguards emerge. Anonymous aggregation. Decentralized processing. No individual profiling. Trust becomes essential. Money stops being a test of intelligence. It becomes a system of care. Finance shifts from domination to stewardship. Before psychology, mental health was misunderstood. Then science intervened. Emotional finance follows the same arc. Emotionally stable strategies outperform reactive ones. Patience becomes profitable. It's not morally, mathematically. No system eliminates uncertainty, but damage becomes localized, not systemic. Markets bend instead of breaking. We are not rational creatures who feel. We are emotional creatures who think. Finance finally adapts. What if emotional intelligence optimized all financial planning and investments? Panic would lose its power. Greed would lose its grip. Fear would no longer dictate the future. Not because humans changed, but because systems finally understood them. If markets can sense emotion,